Good morning, everyone. Good morning. Welcome to today's MNI Webcast. I'm Pedro da Costa, and it's my pleasure to be joined today by Richmond Fed President Tom Barkin. Thank you so much for being with us today, Tom.
No, looking forward to the conversation, Pedro.
So we're excited to welcome President Barkin back to this forum just a week after the FOMC's latest decision. Of course, they kept rates on hold. And of course, after the latest reading on CPI led to audible sighs of relief around Wall Street. The start of the year, of course, was not a great one on the inflation front. We had a string of hotter than expected readings that prompted many people to push back their expectation for rate cuts later into the year. And now we're talking about 1 or 2 rate cuts later this year rather than 6 or 7 for the full year as we were when we entered the year and when we last spoke to Tom in this very forum. So what exactly is the state of the economy and the outlook for inflation as we approach the second half of 2024? Well, we have the perfect person to answer all of our questions. President Barkin kindly joins us today for an extended Q&A lasting up to 1 hour and 15 minutes. And I've got lots of questions of my own, but this is meant to be an interactive session, so we welcome as many questions from audience members as possible. Please don't be shy and make ample use of the chat function to ask your questions, which we'll be monitoring throughout the session. The webcast is open to the general public and is fully on the record. And with that, we'll get right into it. Thanks again for joining us. So, of course, we just had the last meeting in the dots, and naturally, that's what I want to really get into, of course, as a Fed reporter. But I wanted to start with a broader question.
They are. It's 19 individual forecasts somehow aggregated into a median, but let's do that.
Indeed, but that's why I'm not going to start there. That's why I'm going to give you a broader question to kick us off with, because as I prepared for this, I was thinking you've now been a policymaker for 6 years, right? So that's a pretty long time, and I wanted you to reflect back on your experience to date, and tell us kind of what lessons you've learned in the job that inform how you look at your decision making, in the next 1 to 2 years.
Well, I think really seminal in this whole thing, it's been quite a roller coaster over 6 years. You had the 2018, 2019 period, tariffs were coming up, uncertainty, framework review got started. Then you had 2020, 21, 22, COVID, how are you going to handle that? Then you have the inflation era. Hopefully we're on the backside of it. So the job's always interesting. I'll start with that. I started in the job imagining that engagement in my district would be a way to gather differential insights and have real value added in the conversation. And we started slow, but when COVID happened, we really put it on steroids. You had the ability to do a Zoom call like this 3, 4, 5 times a day. And when COVID ended, our team basically said, let's not stop that. So I'm just the Energizer bunny out there trying to get insights. I've already been, I was in Florence yesterday and did a thing with the South Carolina chamber there. I'm in Rock Hill, South Carolina today. Florence is in South Carolina, for those who don't know that. I'm in Rock Hill today, which is about 30 or 40 minutes south of Charlotte, with the chambers there. And in all these opportunities, you get to actually gather real insight. And that's what the biggest thing I think I've learned, and you learned during COVID, which is there's only so much you can figure out from the building. And it's really helpful to try to validate the data you're seeing or the judgments you're making off the data you're seeing with what's actually happening on the ground. And that's what I'm trying to do. I really do think it helps. When you ask questions like, have we broken the back of inflation, or is the labor market in balance, or how close are we to recession, or how much weight do you put in the latest signals coming from any particular piece of data? I think it's really useful to test what you're seeing in the data with what we're hearing on the ground.
Yeah, and I've seen you in action on the road, and to be honest, you act a lot like a reporter in terms of the voraciousness with which you ask questions. So I know
we had Odd Lots down in Mount Airy a month ago, and their biggest conclusion at the end was they could be a Fed person. So maybe we are more similar than we'd like to admit.
Well, in the survey aspect of, asking enough people questions to get like a median view, I think is very similar. So that's kind of what I appreciate about the regional Fed system as I've covered it over the years. let's get into the inflation picture then, given that it's still kind of the major problem facing the Fed. How would you describe the arch of inflation over the past, say, 12 months? We had a very benign second half of last year. Things got a little bumpy in the first quarter, but how are you looking at the last couple of months? Have they reversed? Have they made you think that the first quarter was not a trend, or are you still concerned and need more evidence?
Well, we're clearly on the backside of inflation. I think there's no question in my mind. That's been helped in part by restrictive monetary policy. That's been helped in part by supply chain challenges being resolved and labor market coming back into better balance. But the question is, are we all the way back? And I think it's hard to know how much signal you take from the last half of last year, how much signal you take from the first quarter of this year, or how much signal you take from the most recent couple of weeks. What I hear on the ground is, and I'll take a longer horizon on this, is there was a period before COVID where people who set price really didn't think they had any chance to exercise pricing power. That was a combination of e-commerce, globalization, the power of big box retailers, embedded inflation expectations. But even I remember back in 2018 and 2019, you would talk to folks after the tariffs hit and ask if they were going to pass those on in prices. And they'd say, I just don't have the power to do that. Okay, so you had no chance, but then COVID happens and you have supply shortages, whether they be labor and materials, you've got cost increases, whether they be labor and materials, and they'd be sector-wide. And businesses across the spectrum said, I've got no choice. I've got to do something. And so they went to Walmart, or they went to Home Depot, or they went to the customers and they said, we've got to increase prices. And they were nervous about it at first, but they found there were no consequences, because in the context of the widespread craziness of 2 years ago, people accepted price increases. And so you went from having no chance to having no choice to having no consequences. Prices went up and volumes didn't move much. And it's tempting to declare this round over. It's tempting to say there's no chance again. But I don't think that's quite true. Or maybe to be more clear, what I'm hearing is on the goods side of the house, home goods, apparel, I do hear the same thing I heard 3 or 4 years ago, that the pricing power has sort of waned. But on the services side, and I'll put shelter in that, on the services side, I think people are still exploring the opportunities. And I think they still think there's no crime in trying. I mean, that's what I hear. And so the net of that is, goods pricing, goods inflation feels to me pretty much back to where we were before COVID. Shelter and services, not quite there. Not quite there. And so that's what I'm hearing. Very open to that being wrong. And of course, this month's results very encouraging. So we'll see if we get more of that.
So when you say not quite there, is it a concern about, like, let's talk about shelter in particular. Is it something you can read through, or is it really that you need to pay attention to inflation, whatever it is, and if the expected, this expected abatement in shelter inflation that's supposed to take place because of what you're seeing in market rents, if that doesn't somehow filter through to the main numbers, then are you just not able to cut rates in that case?
Well, you can get to 2% lots of different ways. Right. So I'm not bound and determined to be exactly in the same ratio that we were in 5 years ago. And you can make a pretty good case that shelter has more prominence in the spending basket today when people can work in a hybrid environment. So it wouldn't stun me to have get to 2% with more inflation in shelter and somewhat less in services and goods. That's a perfectly reasonable way to get there. But I do think when you looked at the 2% of the last 6 months of last year, it was still very high on shelter and services, still deflationary on goods. And that just made me a little nervous, as we sort of saw in the first quarter this year, that if goods deflation were to slow down or cease, you'd still be left over 2% in total. We'll see how we get there.
Yeah. What are we to make of the FOMC's upward revision? I know it's a median of 19 different people, but the market was a little bit befuddled by that because, some folks think we're already going to be potentially at 2.5 on PCE next month. So is that a reflection of the the sort of worse than expected data at the beginning of the year pushing back the timeline for how soon you can reach something that's closer to target?
Well, I won't speak for my other 18 colleagues. I'll just speak for myself, which is as as we filled out as I filled out my SEP in December, I was quite aware that the prior 6 months of inflation, however we got there, had been at our target, and wasn't far from saying, wow, a few more months like that and we're really, on the road. And then January and February came in hot, March as well, April a little bit less so, and May looks like it's going to come in less hot. But you have to be influenced by the results you see. And I certainly didn't get more confidence from the first quarter of the year in terms of inflation settling. We'll see where we go.
How are you looking at service dynamics, and is wage growth part of your worry? Is that why super core became a worry in the first place, because wage pressures could become embedded in those sectors?
I mean, wage growth, of course, affects some of services, and it's still a little bit higher than it was before COVID. But productivity could also take a tick up and handle that. So I'm not one of these people who says it's about wages, but just look at the categories we're talking about. Insurance. Well, what happened to insurance? Well, auto prices went up. What's happened to homeowners insurance? Home values and construction costs went up. That takes a while to feed through the inflation snake. And I'm really more focused on the behaviors of price setters. I was in Columbia, South Carolina a couple of weeks ago, and I talked to someone who's in a home services business, come to your home every month. And they said before COVID, they would never increase prices because they were just too scared to do that. They've increased them a bunch, and they go, well, that was just a mistake on our part. We've got to be up 3 to 4% a year. So that's a whole sector of the economy that's changed its pricing strategy. And I've tried to study the mid 80s when the whole Volcker experience happened. Inflation doesn't just go down to 2% in a second. I mean, I do think there are, I'll call it echo effects, where some of the things that happen actually play out over time. And I anticipate that's what we're seeing, but again, we'll see.
And auto insurance is kind of a prime example of that, right? It's kind of the second round effect. Yeah. Right. We have a question from the audience, which speaks to the inflation issue. And the questioner is wondering which specific inflation measure you are targeting and which inflation measure you're looking at. They're asking if whether it's core PCE, super core, headline, and how many months at 2% before you start to cut. Now, I know you've said you don't need to get to 2% before you start to cut, so I can answer that part of the question. But how are you looking at these things broadly?
Yeah, I may shorten the session by saying all of the questions that say what exact formula are you looking at, I'll try to deflect. But I think you want to look at all of it. But for me, it's sustainment and broadening would be the two themes to talk about. Sustainment means that headline and core, continue to operate in a path that gives you confidence you're heading to 2%. Okay. And broadening means it's across the basket, not just driven by, a small number or small percentage within the basket. I think it's still the case, and I won't get these numbers perfectly, but in the last PCE, it was over 50% of the basket still had over 3% year over year PCE inflation increases. And before COVID, that number was like 26%. And so you've doubled the percent that's over 3%. That's not a broadened thing. That's a few things coming back to, cars, for example, coming back from pre-COVID spikes. And I think sustainment and broadening, that's what I'm looking. And for broadening, you can look at trim mean. There are a lot of different ways to look at that.
Yeah. Yeah. In terms of your regional contacts, where are they in that journey of running into resistance for price increases? We got some evidence from the Beige Book that it's getting a little bit harder, right, to pass those on. Is that something that's prevalent? How does it vary across sectors, and is it encouraging to?
Goods, overall, I'd say goods strong, services less so. Within goods, anyone who's in the residential market, you sell decks, you sell furniture, they're past it. I think they're feeling all the resistance in the world. I think the food providers, they've gotten to the point. If you look at the earnings reports of the big food manufacturers, you'll see that a year ago they were still doing price up high single digits and volume was flat to down 1 or 2. If you look at the most recent quarterly earnings reports, you'll see their price up 2 to 3%, volume down 2 to 3%. They're kind of done, on the food side. And the Walmarts of the world are pushing back very strongly against food manufacturers, saying, okay, now it's time to turn the table. So those are a few. Apparel is another sector where you definitely see that we're back to the old world of excess capacity. We're starting to see cars. As I'm talking to you, I see those prices going. So a lot of these goods see it, but the classic, pay every month kind of services, they're not seeing it the same way. And I think that's the rest of the puzzle.
And how are you thinking about, we have a question from the audience about the labor market. How are you thinking of the labor market vis-a-vis the inflation picture? This questioner asks what kind of cooling in the job market you need to see in terms of the unemployment rate to start cutting. But I would just broaden the picture to ask you whether you're, when you look at a payrolls number like the one we had a couple of weeks ago, is that something that you think can coexist with inflation coming back down to target, or does it kind of give you pause that maybe it's a little too hot?
Well, so the headline, just like the headline inflation numbers are headed exactly in the right direction, the headline labor numbers are also very healthy. You're seeing 250,000 plus or minus jobs added a month. You've got unemployment at or below 4% for 30 months in a row, first time since the late 60s. Just as I pointed out some concerning things beneath the inflation number, I'll point to some, concerning things underneath the unemployment number. One of them is the hiring rate has dropped a lot. The private hiring rate is now at 2014 levels, which wasn't, the strongest hiring market that I remember. That hasn't shown up in the jobs numbers in part because the separations rate is also very low. And part of that is the turnover's down, and part of that is, companies having fought so hard to find and attract workers 2 years ago aren't, quick to the trigger to separate workers, but that can change quickly. And so that's, one piece of the puzzle that I'm watching closely, which is, are we going to see an acceleration in the layoff rate? Or are we going to see a return to aggressiveness in the hiring rate? That's, one balance to look at. The second one is obviously the job gains that have come through in the last year and a half have been almost 3/4 in 3 sectors: healthcare, social assistance, leisure and hospitality, state and local government. And those are 3 sectors that got way behind during COVID, that didn't feel they had as much wage power, the ability to raise prices to fund higher wages. And so they've been slow to get workers back. And so if you say we're adding a bunch of jobs, but we're still in pandemic catch-up mode, then you do get worried about what happens once they catch up. And there's been some debate on the leisure hospitality side on whether we're there. I'm not sure we're all the way there, but certainly closer. And then, of course, you've got the other 2 sectors. Healthcare and social assistance still has a ways to go, I think. State and local government, highly dependent on revenues. But that's another, I'll call it, fault line within the labor thing, and you watch that carefully. Our mandate's dual, and so you watch the labor numbers, you watch the inflation numbers. At this point, it's still very straightforward to me, which is the labor numbers are very strong, and the inflation numbers are not yet at target. But it's not hard to envision scenarios where the labor market weakens.
Yeah. What about the consumer outlook? There's a lot been made about the idea that the consumer is tapped out of excess savings, but some economists have pointed out to me that we've had very low savings rates before, and Americans are perfectly good at spending more than they have. So just because we've depleted the savings doesn't mean that consumer spending is going to hit a wall. But at the same time, we had a second weaker than expected retail sales report this morning, and some folks on Wall Street are kind of thinking that there are cracks around spending that should be watched. Where do you sit on that?
When I talk to businesses, what I hear is that consumer spending is fine. I don't hear buoyant or frothy or overheated, but I also don't hear falling off the table. And I'd say that's also what I heard 3 months ago and 6 months ago when the consumer spending numbers were coming in very strong. And so I think The numbers that were really strong, let's say last October or in January, were not as strong as they are in real life. I think the numbers that are coming in weak also don't feel as weak as they are in real life. So I think consumer spending is solid, not frothy, not weak. You know, and I think the dynamics underlying it at this point are less about excess savings and more about the fact that if you want a job, you have a job, and real wages now are trending up as opposed to 2 or 3 years ago. And at the same time, the stock market's at record levels by at least a couple indices. And so those people with wealth have more wealth, and those people with less wealth have jobs. And those are the dynamics that will support consumer spending. Obviously, those could change. And so, good outcomes are not an entitlement. They're just where we are today. And so you do have to be thoughtful and monitor if those things change. And if you just start seeing a lot of people getting laid off, that's going to change things. And similarly on the, if you see the markets crater. One interesting thing is a lot of talk about the lower end consumer being stressed. And for sure, when I talk to people who market to lower end consumers, you do hear that their volumes are challenged, or the revenues are challenged. Interestingly, though, those people who have put in promotions, this is my advertisement for price decreases if there are any businesses on the thing, but those people put in promotions. You've seen news recently about McDonald's $5 meal or Target, but they're seeing a real return from those promotions. And to me, that suggests that there's still spending power in the lower end consumer, but faced with higher prices every day, they're actually making choices about where they spend. And so I think people who are offering a value outcome to the lower price consumer, Walmart is another good example if you go to the recent earnings report, are seeing really good results in ways that those people who aren't offering the value outcome are not. So to me, it's less about a stressed consumer and more about a choosy consumer.
Okay. Well, that suggests there's some price competition, which is, of course, positive news for inflation. So,
right, I just put that advertisement out there.
I want to get into the labor market in a little more detail, but let's get into last week's meeting, if you don't mind. Some folks basically think that the Fed did a hawkish pivot, just as I mentioned, just as these cracks are starting to emerge in the economy. One of our questioners asked, why did FOMC members not revise higher the unemployment projection at year end, given that we're already at 4%? Can you talk a little bit about, how you felt about last week's decision and where you are, broadly in terms of your patience on policy and need for more confidence?
Well, I voted for it. I'm obviously very supportive of last week's decision. Look, I think there's a very interesting choice to make as you think about the most recent data. You could decide to take a lot of signal from the last half of last year. And if you took a lot of signal from the last half of last year, you've got a very vibrant economy and on-target inflation. You see soft landing right ahead in your sights, and that would give you one frame on policy. Or you could take a lot of signal from the first quarter of this year. And if you saw the first quarter of this year, you would have seen very strong economy continuing, but inflation, potentially reaccelerating or at least not settling. And that would give you a second frame on policy. Or you could take a lot of signal from the last month's data. And in the last month, you could make the argument you've seen the economy flatten out, though we did add over 250,000 jobs last month, but consumer spending, retail sales. And you could argue that while we haven't seen it in the PCE, based on the CPI and the PPI, most people would project a PCE that would be very much in line with our target. And so that would be a third frame on policy. And you could decide that it's so clear to you that right now you know which of those three frames you've got, but that's not where I am. I don't think it is good. I mean, so we will learn a lot more over the next several months, and I think we're well positioned from a policy standpoint to react based on which of those three or some fourth scenario comes in.
Is July too soon to make any moves? People seem to have ruled out July as an active month.
Well, you can always come up with scenarios, but I don't talk about particular meetings.
Sure. Asking it the other way, is there a decent chance that we might not get any cuts at all if the data evolve in such a way?
How many more times do you think I should try to deflect this question?
Okay, let's switch it up to something related, but not the same thing. Do you think the SEP is an effective communications tool? Because as someone who has to convey the message of the SEP to the public, I sometimes like it and I sometimes hate it. I think you guys seem to feel the same way. I find there's a love-hate relationship within the Fed with the SEP. But how do you, some of your colleagues have voiced various opinions about potentially making changes. How do you think about the SEP as a tool?
So I think it's an extremely effective tool for me personally. In every SEP round, I sit down with my team. I've got some great modelers. We go through their forecast of the economy. We compare that with the staff's forecast and the forecast of outside forecasters. It disciplines me to think in an integrated way about how my policy points of view fit with my views on economic conditions. And I often learn a lot about how to think about policy going forward based on this own exercise. So I'm highly supportive of this exercise internally. Second, it's an extremely good communication tool for me within the committee, because when you get to the policy round or the economic conditions round, if you didn't have this, it's not clear that everyone would lay out their own forecast, at least as specifically. And so the ability to understand whether you were more or less pessimistic or optimistic than your colleagues on the forecast, how those forecasts tie to policy.
Yeah.
For somebody who might be arguing for a more dovish or a more hawkish stand, I think that's also extremely useful. The public communication of the SEP, I think there are times where it's extremely helpful to the chair, and there are times where it's extremely not helpful to the chair. And I definitely don't think that the synthesis of the SEP into a dot plot is one of those syntheses that has proven to be the right way to think about the messaging.
Yeah.
And so, I'm constantly out on the road, as you know, and I'll have people say, "What happens? You guys promised 6 rate cuts last
Exactly.
December." And I'll say, well, now, first of all, the SEP in December had 3 rate cuts. So that was somebody else who said 6. Some of you may be on the phone. And I said, second of all, it wasn't a promise. And third of all, it wasn't all of us. So, I mean, it gets down to a broader conversation about forward guidance. I think forward guidance is an extremely useful tool when it's valuable. But I don't think forward guidance is always the right tool. I mean, if you ask me today, do I think we're in an important forward guidance situation? And it's really important that we forward guide, given my sense of uncertainty, as I talked about the various paths. No, I wouldn't say that. So, I believe in forward guidance when forward guidance is important. And I think when forward guidance is important, the SEP is a useful tool for forward guidance. But I don't think forward guidance is always important. And I don't think it's particularly valuable right now.
Thank you for that. That's really illuminating. I was at the Brookings conference on the framework review on Friday, and I kept thinking about the fact that, especially since Ben Bernanke was there, then when then Chair Bernanke launched the SEP, the whole point was to message out the idea that rates would be low for a prolonged period, and therefore the promise was very important, and to see it on paper was very valuable. Now, as you mentioned, that there's so much uncertainty around the timing and extent of rate cuts, the more you communicate, the more you bind yourself in funky ways. And that gets to a really interesting question from the audience, which is there a possibility that you could do 1 or 2 kind of insurance cuts to adjust the level of restrictiveness without embarking in a series of cuts? And does the SEP bind you in some way to like promising X amount of cuts over a certain number of years? And does that create problems for, like, the ECB has signaled that they might just cut once and then hold. Why can't the Fed do that?
You could certainly define scenarios where that would be a sensible way to go. And I don't think the SEP binds me in any way. I mean, the SEP is a forecast at a moment in time. I'm one of 19 dots. If the forecast evolves in certain ways, then you react appropriately. So I don't, like I said just a second ago, the folks who think the SEP is a promise or a commitment or even specific forward guidance, I think are missing the difference between the statement and the SEP. I have believed historically that forward guidance embedded in the statement was a commitment, and that breaking that commitment, if you will, even though there are out clauses, is a meaningful choice to make. I don't see the SEP as a promise or commitment. I just see it as a forecast. And the one thing you know for sure about an economic forecast is it's going to be wrong. And so the notion of saying a rate outcome out of an economic forecast is a commitment or a promise, that just doesn't feel like the right way to think about it.
Yeah, that's a useful distinction. Let me ask you a question, again, comes from the audience, but there's been this wide-ranging discussion following last week's SEP. I wonder if you could clarify things for us. So Chair Powell said that people did get a chance to revise their forecasts after the CPI, and some did and most didn't. Some folks interpreted that as, so I guess the dovish read on that was people saw the CPI, and even though it was better, they didn't incorporate it. So, they have a bit, their reading of inflation is even more benign than what's out there. The hawkish reading was that the SEP was somehow stale because folks just didn't take the opportunity to update the forecast. Did you personally update your forecast, and could you clarify how that process works?
So I think I'd just take the chair at his word. The process we always have is you do the SEP the week before, you submit it on Friday afternoon, I want to say. The staff then aggregates it over the weekend, and we get a chance to see it Monday before the meeting that starts on Tuesday. There's a briefing on Tuesday on the SEP where we talk through, of what we said. People ask questions, and then everyone gets a chance to comment on economic conditions and on policy. And it is always the case that the door is open to submit revisions to your SEP. And I'm actually not one of those people who watches the revisions all that closely. So I just take the chair at his word that said, as he said, that it's always the case that some people respond and many people don't. I think that's what he said.
Great, thank you. Can we talk a little bit about policy restrictiveness? How would you describe the level of restrictiveness? What's your preferred method for gauging that? And given your openness to the idea that the neutral rate is a little bit higher, how are you thinking about those dynamics?
So rates are 5.3. If you talk to somebody in commercial real estate, they'll tell you it's restrictive. If you talk to someone in residential real estate, they'll tell you it's restrictive. If you talk to someone in banking, they'll tell you it's restrictive. Even in manufacturing, you clearly hear it's restrictive. And so it's my strong sense that we are at a restrictive level. And I think you can take a positive signal out of the lowering of inflation, or if you want to credit that to supply chain, out of the cooling in the labor market, in terms of jobs gain coming down over time, or the cooling in consumer spending. It definitely feels to me that it's restrictive. I think there is a fair question about how restrictive we are, in part because the economy seems to have plugged along quite nicely, even though rates are restrictive. And to take both sides of that debate, you could say, well, maybe it's not restrictive as we thought, or maybe you'd say, the full impact of higher rates just operates with a longer lag than you think, because 92% of mortgages in this country are fixed rate, and a lot of people refinance their mortgage or paid down their credit card debt or refinance their corporate loans or paid down their loans. And so we haven't felt the full amount. But you do have to take some signal from the strength of the economy. The models which are out there, including one from the Richmond Fed, they do actually leverage the data. So this is not necessarily a separate point, but all of the models have come up 75 to 100 basis points from where they were a couple of years ago. And so you can take some signal from those models. I should caution everyone, the confidence interval in all those models is mammoth, but still the center of those confidence intervals has gone up. And so you could take some signal from that. I think you could also make a fairly reasonable, let's call it underlying dynamics argument. Bernanke talked about the savings glut. That was a lot of demand for savings at a time where there was not that much supply. Well, the supply of Treasury instruments is up quite a lot as deficits have expanded. And you could argue that some of the demand has come off, whether that be from countries whose interest rates have now gone from nominal negative to nominal positive, to China and their interest in decoupling or disencoupling. And so you could argue that some of the savings club thing may be behind us. Productivity, you could argue, is up. The last several quarters have been quite encouraging. Now, the quarters before that were less. You could tell an artificial intelligence story. So I think you could make a reasonable argument that it's been drifting up. And I've got a lot of empathy for that argument. This is the time where I go, but it's really hard to use this tool all that well as an instrument of policy because it moves and it's got a high confidence interval. And so, how do you know how restrictive you are? I think the way you know it is by what you see in the economy. And so that's why I think it's a worthy effort to take rates to a level that all of the models would agree were restrictive. And based on the SEP, all of my colleagues would agree are restrictive. And let's see what we learn for having rates at this level. I think we're learning that it's cooling the economy in the way that they want to, but we'll see. Maybe
so that makes a rate cut is not your baseline, I assume, like your colleagues usually say. That's kind of not in the cards. Or how do you think about the possibility of the need for additional tightening down the line?
Sorry, you said rate cut. Did you mean
no? I'm sorry, rate hikes. Yeah, no, especially so. A lot of folks are expecting that a second-term presidency, no matter who wins, might lead to further fiscal profligacy and therefore might kind of up the level of stimulus on that front that you guys have to contend with. So how open-minded are you to the possibility that further tightening might be needed into next year?
As I said a little bit ago, I'm always open-minded. I think you got to adjust the rate based on what you learn. And if what we learn feels like overheating, then that's the case to increase rates more. If what we learn is the economy is cooling, but just not as quickly as I might have thought, that's sort of the case for keeping rates where they are. And if the economy is weakening meaningfully, that's the case for cutting. It's not that complicated, but
Gotcha.
What is complicated is knowing where you are. The reaction function is not the hard part. It's the diagnosis of where you are in real time. That's the hard part.
Sure. We have a question from the audience that's asked just exactly how you incorporate fiscal policy into the monetary reaction function. How do you, because it's difficult. It's a difficult exercise for the Fed, I understand, because you're limited in how much you can discuss fiscal policy, and yet you do have to take it as a given when it arrives, and it probably had something to do with the inflation that we experienced, right?
Well, that's where I was going to go, which is we have a narrow mandate and a simple set of levers, and you have to take the world as it is. If there's a war in Ukraine or not a war in Ukraine, if oil prices are spiking or not spiking, if you have fiscal spending or not fiscal spending, if you have fiscal initiatives that create supply side strength or fiscal initiatives that work against that, all of those are I guess the environment you're in, you make policy against that. So, if there's a big fiscal spending on infrastructure, which of course there is, that's going on, that's using construction workers, right? And that means that the price of construction workers is higher than it would have. There's some basic economic factors that do flow into what you're seeing in the real economy. So they're explanatory, if you want to put it that way. And then you make policy against the economy you've got.
Yeah. One other factor that complicates things, as if they weren't already complicated enough, are the policy lags. And I wonder, we haven't talked about them a lot recently, but I wonder how you're thinking about those in two ways. A, where are we in the lags from tightening? And then given the lags of an eventual easing, how do you think about the risks of falling behind the curve there? Because it's going to take some time between the time you ease and the time it starts to have its effect.
Yeah, so I do think the lags are longer than most people thought. And I do think a big part of that is that the full impact, like I think I mentioned this earlier, but just to give you the numbers, the total interest burden on corporates as a percent of corporate revenue is only now back to 2019 levels. The total interest burden on households as a percent of disposable personal income is only now just back to 2019 levels. So while you and I think we raised rates from 25 basis points to, 5 1/3. In aggregate, there's obviously individuals who are hurting in corporations too, but in aggregate, the burden's about where it was 5 years ago. So that's just an interesting way to look at it. To me, that makes the case that as corporations refinance and households, eventually buy that house, you're going to see more impact of interest rates than you think. So I think the lags, at least at this point, are longer. I mentioned mortgages, and I won't get the numbers right, but I think I remember that in 2008, roughly half the mortgages that were issued in this country were ARMs. And I know in 2019, the number was 8%. And so that just shows a different transmission vehicle, right? If you've gone from variable to fixed rate, that's a different transmission. And I think that stuff's out there in lots of places. You mentioned fiscal. There's been a lot of that spending that's leaned against monetary policy. You talked about excess savings. There's a lot of input that's leaned against monetary policy. Even the markets, where normally you would think if you raised rates, the markets would drop. Markets are still very healthy. That's leaned against that policy. So, I do think the lags are still out there. Oh, and then your other, how do you get the timing right?
Yeah.
Well, I think the expectation that we're going to get the timing perfect is a very difficult assumption. And I actually don't even feel like that's the right standard. The one soft landing that's described as the perfect soft landing in Alan Blinder's book is the 94, 95 one. And I read that book with interest because, I want to know, and then I went to the transcript, what was the environment when they made that first cut? And the answer was that it had negative job growth for 2 months. And so in the context of negative actual job growth for 2 months, they made their first cut. The next month, that job growth got revised up to positive. So that's real life. So they were perfect, right? Except, well, so how did they know? They didn't have some crystal ball that said, okay, the jobs are about to, they looked at the actual and those numbers were wrong. And that's part of why they didn't do the second cut for, I think it was 6 more months after that. And that's the reality and the messiness of monetary policy. I think anyone trying to suggest to you that there's a way to get it perfect, that's just not how it works.
Yeah. Imperfect tools indeed. Let's dig a little bit into the labor market and how you're looking at the data. You've given us a little bit of a flavor in terms of your comments on the separations and the idea that people are really sticking to their jobs and firms are really reticent to let people go. But are you putting more weight on the payroll survey or the household survey right now? How much do you read into the rise in the jobless rate? How are you looking at employment generally?
Well, definitely more on payroll than household. The survey size is much smaller. In household, it's much more volatile. The payroll is a much better tool in my opinion. What I hear in the job market is 3 different segments. There's the skilled trades, construction workers, veterinary assistants, truck drivers, nurses. That market is still tight. That is still a tight labor market. There's the frontline service workers. That one's kind of come back into balance. They're still hiring in most of those institutions. They're working with fewer people than they had before COVID, but they found ways to get by. Cleaning the hotel room every other day is a good example. The professionals market, that's actually, I think, weak or weaker. There have been some articles out there. I was at my son's business school reunion. I think half of the people in that class didn't have jobs. Wow. And so, if you're trying to get hired into finance or accounting or tech or consulting or some of those sort of professional things, I think it's a much harder market than you'd think. And so, that's the labor market. It's a mix. Now, I don't know how much of that population shows up in the unemployment rate. Maybe they're not filing for unemployment. Maybe they're taking gig jobs of some sort. But the underlying for those folks isn't nearly as good as the numbers would show. At the same time, I'm in Rock Hill today. The unemployment rate in Rock Hill is 2.8%. Not bad.
Not bad at all. A problem to write home about. How do you think of the supply side of the labor market, including the surge in immigration that we've had recently, and how is that affecting even the reliability of the data, perhaps?
Yes. Well, obviously, a lot of people got surprised at the end of last year when the CBO put out its statement on immigration. believe it to be a credible piece of work. I learned stuff out of it. For example, that folks who claim asylum get work permits. And I think it squares with what we see in the labor market data, which is lots of jobs being added beyond what people would have thought was possible, but wages not really feeling pressured. They're sort of still settling in the right direction rather than going up. You also see participation increasing among prime age workers, particularly prime age women with a college degree and kids under 5. And I think that has a very high correlation with the existence of hybrid work, which either is providing real support to young families with kids, or is providing the perception of a future that could offer that kind of support. But the participation numbers or the employment to population is not going to head in the right direction, because you've still got the over 65s, and that population, the participation in that group is still down. Now I'm talking employment to population, I think 1.6 percentage points versus where it was before COVID. And the size of that group is increasing as my generation retires. So, or ages, I guess. And so, that's going to be a challenge for us. And all of the forecasts would have suggested that for 20 years, but during the 2010s, we weren't faced with that. So, where we are now is a declining employment to population, a lessening of the natural growth rate of the population in the US, but a surge in immigration. And that's keeping the labor market together. But it's easy to imagine, immigration falling. And if it does, questions of whether the labor market tightens are good questions. Or maybe, money runs out and the people 65 and up stop going on vacation and come back and start working in the workforce. We'll see where that goes. I'll also say there's high uncertainty on the productivity side of this. There's a lot of talk about AI, but automation is worth spending a lot of time on. 2 years ago, when you couldn't find workers, what was the thing you were going to do? You were going to invest in some machines that could replace workers at a time where capital was very, very inexpensive. And so people did that. And I see those machines coming online. That's going to surplus some amount of workers. Now, might not be an issue in a full employment economy. And then if you listen to the most passionate evangelists for artificial intelligence, that's a whole nother set of jobs that, might just get enhanced, but might also get replaced. And so we're going to have to sort this out. I think it's going to be a very messy several years to try to understand what's happening in the labor market.
And what are you hearing from contacts in terms of ease of finding workers, desire to maybe lay some off?
Ease of finding workers, the only real issues are still in those skilled trades. Everywhere else, applications are coming in, they're seeing who they're seeing, they're fine. I was with a big theme park operator last night. That's a good example, because everyone they hire is most everyone they hire is entry level. No problem. Applicants are up, they've got it. Skilled trades still a problem. I was with a construction firm this morning who said it's still an issue. On the layoff side, not much, and I think that's the big story: hiring down, firing's down. And I really do think that people are trying to manage it through attrition. They're not seeing the urgency because demand is still solid. And having been through the experience of 18 months ago, they're just not dying to do that again unless they have to. It does create a risk for the labor market, which is if we get into one of those moments where people start firing, right? Think Lehman Brothers, think 9/11. There is excess staff in some of these places that, is at risk. And so, that's a downside risk. Hasn't shown up yet, but that's a downside risk on the labor side.
Absolutely. So I wanted to ask you some financial market related questions as well. I'm wondering what you make of the recent decline in 10-year yields. When yields rose a lot, there was a lot of talk about the market doing the Fed's work for it. I know you didn't buy into that idea. I remember you pushing back against that. But I wonder how you think about this weird loop that we're always in about kind of financial conditions loosening ahead of the Fed, and then the Fed having to stay higher for longer in response to that. How do you think of that dynamic?
Try really hard not to think of it. I mean, we don't control the markets. The markets do what they do. Let's assume for a second you have really smart people making bets on both sides of the trade. They may be right, they may be wrong, but they're making those bets. I do think we have a reasonable amount of influence over the first 2 years of the yield curve. And, that hasn't moved around nearly the way the 10 years moved around over the last, 9 months or so. You could articulate why the 10-year has gone down for many reasons. You could articulate it as having some relation to long-term policy, not short-term policy, really, long-term policy. You could articulate it as, like the real rate, for example. You could articulate it as being increased confidence on inflation. You could articulate as supply-demand, flow of funds. I mean, there's a lot of reasons for it. And I'm sure on the call are a lot of people who understand it better than I do.
And how do you think about the prospect of entering an easing cycle with markets still kind of already looking frothy, with stocks at records, with credit spreads tight? Is that something that enters your calculus?
It's not so much that I spend any time thinking about whether this, stock values are going to go up or down or not. But I do try to think about the real economy. So housing is a good example, and housing prices. There's a story out there that says, why don't you just lower interest rates today so that home builders can build more housing so we can get to the other side of this housing crisis? I get asked that question all the time. And I keep saying, help me with this, because there's a horizon problem, time horizon problem. If we lower interest rates tomorrow, we may well stimulate some home builders to start asking for permits, and 3 years from now, they'll build a bunch of houses. But the immediate reaction is that rates are going to come down and demand's going to go up, and the housing market's going to get frothy again. And you'll have 14 bids for every house, and it'll go over list, and that'll increase housing prices. So to me, it's less about the markets and it's more about sectors that could be influenced in ways that don't. I still hear, for example, the housing market, I'm still hearing multiple bids per property. Properties are still selling in less than a month on average. It doesn't feel like a weak housing market. It feels like a. So I think about it more in that context than I do in a classic financial markets context.
Got it. So you worry that you might get an excess housing boom. So it's more of a macro bubble concern than a market bubble concern, if that makes sense.
Economy versus markets, right?
Gotcha. That makes a lot of sense. We have a question from the audience that asks what your thoughts are on the yield curve. We've stopped talking about it because it was wrong this time, at least so far. It's the longest it's been negative in recent memory. Why do you think it is where it is? And does an inverted yield curve require higher Fed rates, everything else equal?
Well, I don't think you can declare it wrong yet, because those people who have said that the yield curve predicts every recession actually had at least one of those recessions happen 4 years after it inverted. And so somebody is going to write the article saying the yield curve was right again.
Eventually.
Expect that. No, I think you can come up with lots of reasons why the yield curve is inverted now. There could easily be people who are still expecting a recession to come with a meaningful drop in rates. There could be another sector of investors who imagine inflation will come quickly under control, and that'll come with a drop in rates. It could be lots of reasons. A lot of I'm giving a speech on this next week, and a lot of the regularities that we sort of take a lot of signal from have not been as spot on in this cycle as in some other cycles. The yield curve would be one. You could look at the Conference Board's leading indicator index, which also predicted a recession for, I think, 2 years in a row until February. You could point to the impact of interest rates on the economy, the lags. There's a lot of stuff that we would have expected to, and I think we're going to have to get our arms around, what do we learn from all this and why? And I do think this particular episode has been different because of the impact of supply chain, because of all the fiscal that supported spending and excess savings that supported spending, maybe even because of the health part of this and what that did in terms of people's willingness to spend or not. We'll learn a lot as we go. But I sort of agree with you. I don't think the yield curve this time has been the signal that most people expect, but I don't know. It inverted in 2018 maybe, and so we were absolutely going to have a recession, and we did have one. It was just called a pandemic. I'm just not sure how predictive it was of the pandemic. It's a signal, but I'm not sure. I think we've all made too much of it.
Yeah, another thing that used to be front and center and now is relegated to kind of the end of discussions, like where we are now, is the balance sheet. And I wonder if you could speak a little bit to where, how you're thinking about your announcement that you're going to slow down the runoffs, how you think about the interaction of QT with the Treasury market, because of course it has some impact on yields, even if marginal, and whether that interaction worries you in any kind of fiscal dominance, overlapping of duties kind of sense.
Well, I always say if you believe that quantitative easing has any impact, then you have to believe that quantitative tightening has an impact. I mean, I think you have to be symmetric in your thinking. There's a piece of that impact which I'll call physical. More demand for bonds, less demand for bonds increases or decreases the yield on bonds. I think there's another aspect of it that I'll call metaphysical. When Bernanke stood up and said, we're not out of arrows in the quiver, I think businesses responded. And I think the metaphysical part at this point is liquidity. If markets don't believe there's not enough liquidity, I think you have those reactions. We used it as a tool during the pandemic. I think it'd be very fair to argue that it was overused as a tool during the pandemic. We're now scaling it back. I think that's an important thing to do to preserve its viability as a tool. If you have an ever ratcheting balance sheet, you really do get to fiscal dominance. And so I think I've been encouraged so far by what my perception is the lack of meaningful noise in the markets as we've removed, I think it's $1.6 trillion maybe at this point, something like that from the balance sheet. Highly attentive to market disruption while we do it. Doesn't seem to have been much at all. It's come really straight out of the overnight RRP. The reserves are basically the same as they were when we started quantitative tightening. And so, part of the spirit of shrinking the pace was to slow the boat down as you approach the dock. I mean, it's very hard to stick a landing at full speed. But in my mind, I'd like to push the balance sheet to whatever level is appropriate given here we go, because I think it preserves our ability to use it in the future. I do think it's had to have some effect on treasury yields because I do think quantitative easing had some effect on treasury yields. I don't think either one of those effects is anywhere close to some of the estimates you see in the markets. It just makes no either analytic or empiric sense to me, but I'm just one man. There are others who've studied that a lot more than I have.
Do you think there are long run costs to having a larger balance sheet? Because there are those, diehard folks who really think we should return to a scarce regime.
You could argue there's some political economy risk to being too big of a player. I think in general, quantitative easing is one of those tools that it feels to me we're not in balance on. When you move, you need to move quickly and hard and aggressively. And when you shrink, you need to move carefully and thoughtfully and slowly. And that's a tool that I think is not designed perfectly from a use standpoint. If you're always fast in and slow out, you're going to find an ever ratchet balance sheet, and that's going to be a challenge. So I'd like to find a way to use it because I think it is effective, but use it in a way that's more balanced. I'm thinking of tapering, for example. We sort of signaled we wouldn't taper. That we would taper, that we wouldn't start rate increases until after the taper was done. And, we sort of changed that as we got into it. But there was a slowness to that process that I thought brought a slowness to monetary policy. And it probably was responsible from a financial market standpoint. But it also led to some choices on monetary policy that, if I had overs, I'd probably have done differently. So I think we just need to think about that. None of that has anything to do with today's quantitative tightening process, though, obviously.
Got it. So we have about 15 minutes left, and we have a lot of great questions from the audience that I have not yet gotten through. So I'm going to try to make it a kind of quick lightning round as we approach the end. A couple questions on the elections, which I'll ask totally apolitically, of course. So does having an election raise the bar for when you initiate a loosening cycle? Is it harder to cut right before an election? And is November kind of off the table for that reason?
Let's see. Really excited to talk about the election because there's nothing I want to talk about more. So I'm just not going to talk about it. We don't put it into our thinking, nor should we put it into our thinking. I will say the November meeting is after the election, not before the election,
Yeah,
just from a fact standpoint.
fair enough.
And I don't know who does the scheduling on it, but I think it's always the case like that. I think that's how this just generally scheduled.
It's the one day when the decision will be on a Thursday and not a Wednesday. So
yeah. So I think the job here is to sustain the progress we've had in inflation and bring it down. That is, where all the trophies will be handed out, is for that. The trophies are not going to be handed out for anything other than that. And so we just got to stay very focused on that.
So the other election question, which seems like a sensible one, was whether the Fed should have a longer quiet period around the election, kind of like what the Bank of England has. I think there's a 2-month PERDA around it. Do you think that would be sensible?
No, I didn't know that. I'm all in favor of any size quiet period that you on. I think, I certainly spend my time, as you know, in local markets trying to explain the economy to folks. I'm not out there trying to talk about policy. I do think it's got great value to have that kind of interaction, with the public. I think that's the role of a regional bank. It's one thing I embrace. But I'd be very comfortable with, whatever anyone thought made sense there. I'm not, might free up some time.
Great. Another question is on whether your baseline is for 1 or 2 cuts this year.
I see 3 different scenarios for how the economy's going to go. And I described them. There's the last half of last year scenario, there's the first quarter scenario, and there's the last month scenario. I would respond differently with policy depending on which one comes through.
Okay. How are you thinking of all of the political turmoil overseas? I mean, I know you said you take it as it comes, but sometimes it must feel overwhelming to enter a meeting when there's looming elections in the UK, looming elections in France, a war in Ukraine, war in the Middle East. How do you manage to kind of keep that out of your mind and not panic your way into cutting rates as I might do if I were in the room?
I don't know. I mean, look, we have a great staff. Beth Ann Wilson leads our international division. They do a brilliant job, I think, at every meeting of, synthesizing, I'll call it the noise from the wheat from the chaff, separating the wheat from the chaff. And so, I know a little bit about, global stuff, having been part of a global institution for 30 years. But I'm not an insider into the political events in South Africa or England or France or wherever. And so I take great value out of, getting insights from people who are able to help us with that. And I think it's like anything else. There's lots of craziness in the world. I'm not sure that would be in the top 5 of craziness since I took the job. And no, don't ask the question what the top 5 of craziness was since I took the job, but the pandemic would have been number
1. Okay, we have another one. So here's, in a situation with moderate resilient growth like the latest retails data show, with core PC running at 0.2%, would this be enough for you to cut in September?
Well, I think, we can keep asking that question. I want to keep deflecting.
These are coming from other people, Tom. You can't blame me. So how are you? Let me ask you this. The turmoil of March of last year, the banking turmoil, came, of course, because of high treasury rates. Now, treasury rates have since come down, but is there a concern that higher for longer puts an additional strain on the banking system that might lead to further turmoil?
Well, we obviously supervise the many banks, including the largest ones, and we do want to be always sensitive to what's happening in the banking system. I've, in close touch with the banks in my district. I can tell you they're taking their situations very seriously. Liquidity is strong, capital is strong. And I hope and expect that they're prepared for, whatever economic outcome might be happening, and therefore whatever rate environment you'd have to respond with. One of the things I've been saying over and over again is the difference between where we are today versus where we are in 2001 or 2008 or 2000 or February of 2000 is that people have been thinking about a downturn for a while. People have been thinking about the rate path for a while. Whatever set of initiatives you would do, whether it's to cut your hiring or cut your capital expenditures or tighten up on marginal credit or restructure your balance sheet, reduce inventories, people have already done that. And so I can't think of a business I've talked to in the last month that says, it's full speed ahead. The economy is about to grow 10%. We're going to kick butt here. People are cautious. And that cautiousness means that I expect, whether it be in the banking system or outside of the banking system, people to be less out over their skis than they were in one of those other recessions that I talked about. Now, we'll see, but I don't expect people out over their skis, and I'd be very negatively surprised if they were.
Okay. Another question that I missed, actually, a good question on what you're hearing from contacts on compensation.
If annual merit was 2 to 3% before COVID, it's 3 to 4% now. The sectors that feel like pricing is back to where it was, the goods manufacturers, they're more in the 2 to 3%. The services folks are more in the 3 to 4%. There's a small subset that is vulnerable to union knock-on negotiations, who are giving somewhat more in increases because they sort of feel the pressure from some recent union negotiations. But it feels very sane, from a labor market standpoint, very, very sane. And I do think this productivity, the investments in productivity that were made a couple of years ago in the context of needing to, because you were short staffed, are coming to fruition. And people are also seeing productivity come because 2 years ago, they might have gotten fully staffed, but it was with inexperienced people or high turnover or people with the wrong skills. They're feeling a much better match now in terms of skills. And so I think I am still seeing wage gains a little bit higher than historic, but I'm also hearing productivity a little higher than historic. So I'm actually reasonably comfortable with the balance in the labor market broadly. Now, nurses, construction workers, that's the place where it's still is still tight, but that's a smallish section of the economy.
Excellent. I think I've gotten through all the questions that are not variations on ways to get at your dot. So let me just ask you one final, let's go back to the big picture, which is how we started, which is how are you thinking about, and this is a little bit related to the higher neutral rate, but then versus now in terms of whether we're in a higher inflation regime and whether even the zero lower bound might become a problem again, or whether this experience, one of the positive side effects might be that we get to avoid the zero lower bound in future easing episodes.
Well, I'm definitely one of those people who think when you let the inflation genie out of the bottle, it permeates and it requires a lot more than, just slapping at it to get it back in the bottle. And so I think that's happened and that's what we're doing. And, if you had imagined that this was all supply chain, I think the first quarter would tell you there's still something out there. And so we've let the inflation genie out of the bottle. I think we're putting it back in, but it's a slower process than most people think. Is it inconceivable that we could ever, end up with a lower bound problem? Of course not. I mean, you can come up with lots of economic scenarios that would convince price setters that their pricing power is behind them, and therefore set us into a different world, more like the world we were in 5 years ago now. So yeah, everything's conceivable. I think, there are different regimes here. And so at least in my world, we were in the 18-19 regime, which was, we're at 1.8%, we'll never get to 2, we're worried about the lower bound, what are we going to do? There was the pandemic regime, which is, when the world goes to hell, throw all your soldiers in at once and then, figure it out later. And now we're in this, hopefully on the backside of this inflation regime. And who knows what the 4th and 5th ones will be during my during my tenure here. I think you have to, the world does repeat itself. In 2018, you could have ended up in a conversation where people would have said, because we have an inflation target, inflation expectations are settled, we will never have inflation again. I heard people say that in 2018. And for me to say today, because inflation has reared its ugly head, we will never worry about the lower bound again, I just don't think that's rational. Someday we will.
Fair enough. Good place to end it. Thank you so much, President Barkin. Really appreciate your time today.
Great to be with everybody. Thanks so much.